How is Social Security benefits taxed? If the only income the taxpayer received during the year was his or her Social Security, or the Social Security Equivalent Benefit (SSEB) portion of Tier 1 Railroad Retirement Benefits, his or her benefits generally are not taxable. And the taxpayer probably does not have to file a return. If the taxpayer has income in addition to his or her benefits, he or she may have to file a return, even if none of his or her benefits are taxable. If any portion of the benefits is taxable, the taxpayer should file using Form 1040. The base amounts used to figure the tax on Social Security benefits are $25,000 if the taxpayer is single, head of household or qualifying widow, or $25,000 if the taxpayer is married filing separately and lived apart from his or her spouse for all of current year. $32,000 if the taxpayer is married filing jointly. $0 if the taxpayer is married filing separately and lived with his or her spouse at any time during the current year. How much of the benefits are taxable depends on the total amount of the taxpayer's benefits and other income. Generally, the higher the income amount, the greater the taxable portion of the taxpayer's benefits. Some people have to pay federal income taxes on their Social Security benefits. This usually happens only if the taxpayer has other substantial income, such as wages, self-employment, interest, dividends, and other taxable income that must be reported on his or her tax return in addition to his or her benefits. No one pays federal income tax on more than 85% of his or her Social Security benefits based on Internal Revenue Service (IRS) rules. In order to determine the taxability of Social Security benefits, it is first necessary to calculate combined income, a measurement of income used specifically for these purposes. Combined income is calculated as the taxpayer's total income from taxable sources, essentially the net amounts included on the front page of his or her tax return in calculating adjusted gross income, plus any tax-exempt interest and excluded foreign income, plus 1/2 of his or her Social Security benefits. If this total exceeds $25,000 for individuals, $32,000 for married couples, then 50% of the excess is the amount of Social Security benefits that must be included in income. If provisional income exceeds $34,000 for individuals, $44,000 for married couples, then 85% of the excess amount is included in income. If the taxpayer files a single, federal tax return and his or her combined income is between $25,000 and $34,000, he or she may have to pay income tax on up to 50% of his or her benefits. More than $34,000, up to 85% of his or her benefits may be taxable. If the taxpayer files a joint federal tax return and his or her combined income is between $32,000 and $44,000, he or she may have to pay income tax on up to 50% of his or her benefits. More than $44,000, up to 85% of his or her benefits may be taxable. If the taxpayer is married and files a separate tax return, he or she probably will pay taxes on his or her benefits. Hi, this is Evangeline Giron, an enrolled agent and the founder and principal consultant of Evangeline Giron, Incorporated, which is based in Los Angeles, California. My office serves more than 2,000 clients from all over the U.S. since 2008. I am committed to sharing informational and educational tax and finance videos to empower taxpayers.